Hi, this is Groups Extreme 1. Uh, my name is Hussein.
I'm Jacinta.
Hi, this is EG.
Yeah, this is our financial market view presentation. We analyze the trend and the factor affecting two sets exchange rate and come to a conclusion as to where the rates will be in the next 3 to 6 months. We have looked at AUD to USD and AUD to Japanese yen.
So the first currency we looked at is the AUD against the US dollar. So currently the Australian dollar sits at approximately 75 cents for each $1 US, with an average of 0.7517 for the year. There's a number of factors that affect these exchange rates. The first that we look at is relative inflation rates between the two countries. So currently the Australian inflation rate is 1%, while the US is just 0.8%. These are both below their targets, and for Australia it's the lowest in 17 years. So the factors that are affecting it include sluggish world economic growth, the US versus the Federal Reserve expectations, the US federal election. So Australia's inflation rate is lower relative to the US, which indicates that while they're both quite low and have weak inflationary pressures, that there's more downward pressure on the AUD because prices are slightly higher. Now, whilst there are signs that the US economy will increase in growth and therefore inflation, it's still growing quite slowly, and therefore inflation is expected to remain quite low for the next couple of months. John Williams, a member of the US Federal Reserve Bank, stated recently that expectations are coming in just above 2%, and concurrently with falling unemployment rates in the US, it's expected that inflation in the US will increase again in the next couple of years. According to the Reserve Bank of Australia Governor Glenn Stevens, on September the 6th, inflation in Australia remains quite low, and given the subdued growth in labour costs and the very low cost pressures elsewhere in the world, this is expected to remain the case for some time. Another factor affecting inflation and the Australian dollar against the US dollar is the upcoming federal election in November. So in times of economic and political uncertainty, consumer and business sentiment are likely to drop, which lowers demand and inflationary expectations. Both of these can be expected in the US in the next few months, and therefore US inflation is expected to remain low until at least after the US election has settled down. So despite the stronger possibility of growth in the US than in Australia, it's still some time off because of both weak economic growth and the upcoming election. So therefore both Australian and US inflation rates are expected to remain fairly similar, and thus not have strong appreciating or depreciating impacts on the Australian dollar against the US dollar. So another factor that affects exchange rates is relative interest rates. So currently Australia has a 1.5% cash rate, while the US has just 0.5% cash rate. So again, Australian rates are relatively higher than that of the US. This is the lowest rate in Australian history, and 0.5% is the highest rate in the US since before the global financial crisis. So whilst both rates are extremely low at the moment, the data has been showing that over the past few years, the Australian rates are falling, whereas the US rates are rising. Now, American speculators are expecting that the US Federal Reserve will increase rates again in the near future because of the better than expected employment figures, whereas Australian speculators are expecting the RBA to keep the cash rate low because of the weak inflation in the economy. In August, the Federal Reserve Open Market Committee Chairman Janet Yellen said that there was gaining strength for an increase in rates in the near future because of the expanding economy. Overall, it's expected that the Australian dollar will remain at a fairly constant level against the US dollar in the near future, because the possibility that the increase in the US interest rates will jump 1% quickly to surpass the Australian rates is quite low because of the continuing weak US growth and inflation. So if the US rates do rise as expected, it will lead to capital inflows and appreciation of the USD. However, the value of the Australian dollar won't depreciate too much because of the interest rates are expected to remain above the US for some time. The next factor is commodity prices, which play a considerable role in determining exchange rates. Both the US and Australia are large commodity exporters and therefore are greatly affected by changing commodity prices. Commodity exports account for over 15% of Australia's GDP, and therefore when prices fall, there is a big depreciating effect on the country's currency. Commodity prices are very volatile, and this makes it hard to forecast the effects that they'll have in the future. However, after the catastrophic falls in prices following the mining boom, the prices have begun to restabilise at a lower level than before. It's also expected that the next wave of demand for exports will focus on soft commodities, and therefore some of the downward pressure on currencies due to the low prices could be alleviated if they make the most of this and adapt to the new demands. So overall, the expectation of the AUD against the US dollar for the next 3 to 6 months is that it will remain fairly stable around the current rate because of the low inflation, low interest rates, and sluggish economic growth.
Alright, here's my part of the AUD to JPY. At the meantime, the exchange rate for Australian dollar versus Japanese yen is 1.76.64, which Australian dollar is appreciated against Japanese yen since September 2015 at a rate around 1.85.55. After research, we acknowledge that Australian inflation rate has fallen from 1.3% to 1%. Japanese inflation rate has fallen from 0.2% to 0.1%. We can tell that the Japanese has the lower inflation rate, which we predict in Australia. Less demand for exports, more demand for imports, which lead to the less demand for Australian dollar and the AUD as depreciated against the JPY. In the other hand, Australian interest rate is 1.5% this year and lower than last year, and Japan interest rate is at around 0%. This would attract more foreign investors to Australia and may lead AUD to appreciate against JPY. However, higher interest rate may cause high inflation, so it is still causes the AUD appreciate against to JPY. In addition, Australia's unemployment rate currently is 5.6% and keeps going downward. It appears that Australian economy is getting better. So it appears that the Australian economy is getting better and better. Australia government is putting more focus on growth on Australian economy, especially on non-mining investment, and which has successfully achieved better results than expected. Capitals intend to inflow into strong economics, so it seems more AUD is going to appreciate against JPY. However, non-mining investment policy has pushed out in late 2016, which still need time to recovery. Therefore, in a short period of time, Australia's economic would not sink to enormous growth, and due to other factors, AUD would depreciate against the JPY. So, in my conclusion, Australian dollar expected depreciate against the Japanese yen in the next 6 months. However, we believe it will appreciate against JPY in the future.